All right, Doug Duncan, welcome back to Personal and Professional Best.
Thank you. Glad to be there.
Yep, we last visited with you in July. We had an opportunity to travel and see you in Washington, which was really exciting. At the time, we were talking about, you and I, experiencing the lowest unemployment rate in our generation, and also the lowest interest rates in our generation. If you combine that, we're also sitting, I believe, at the longest expansion in history, 120 consecutive months where the economy had expanded. And you confirmed at the time your housing forecast up 1% from 2018 to 2019, and you suggested that there were some headwinds to potentially get that done. We'll get back to housing in just a minute, but since July, there's been an awful lot of news in the economy, and I just wanted to get your thoughts on some of those as it fits into not only the overall economic environment, but also specifically then to housing, where we'll wrap up. First, the conversation of recession. It has not been, of course, a big conversation for some time. We've been in a 120-month expansion, but it has turned into kind of the regular news channel now, which is recession, are we going into one, et cetera, et cetera. Before we ask you that question as to whether or not we're going to go into one, can you give us a definition, just for our audience, of what a recession is?
Yes, there's an organization called the National Bureau of Economic Research, which actually is the defining organization for when a recession starts or when it ends. And typically, it's not a completely hard and fast definition, but generally it's a couple of consecutive quarters of negative income or GDP growth in the economy. And then they look at several variables, about 5 or 6 different variables, to make that determination. So it's a little bit vague, but that's how economists keep their jobs, right?
Well, we've been running, of course, growth. I think in the second quarter, they just finalized, or at least for the last time finalized their view, about 2.3% of positive growth. So there's no recession, obviously, so far this year. What are your thoughts? Are you forecasting one either in 19 to begin or in 20? What does your forecasting models tell you with regard to a potential recession on the horizon?
Yeah, we don't have a recession in our formal forecast in either 2019 or 2020. We do have growth slowing into 2020 down to around 1.5%. When you get that slow of growth, it's possible that some shock, most people are talking about trade as the potential shock, could occur and tip you over into recession. But it's not actually a part of our recession of our forecast. And part of that reason is that we think that the Fed, which recently cut rates and we think is going to cut rates again in September and again in December, is also expecting a continued slowing in growth and are trying to align monetary policy with that slowdown to prevent a recession.
They got a very interesting, challenging job these days, right? Because they're involved in what the topic is that I want to bring up next, or at least watching, just like all of us are, and that is the conversation between the U.S. and China in terms of our trade partnership, if you will. What I'd like to ask you, real simple, is what do you think? You're not a betting man, I'm not a betting man, but if you were, what do you think about the opportunity for us to get a trade agreement with China? Do you think it's going to take place?
I don't think it'll take place soon. Whether it ultimately takes place, I don't know. There's likely to be some form of an agreement. Will either side achieve all of their objectives? The answer is no. That's why it's called a negotiation. I do believe that they're each weighing the political costs and benefits in a time frame leading up to the next election, but then also past the election, and deciding if there's not an agreement before the election and President Trump is reelected, how does that change the dynamic in that time frame? So you're getting out to 2 to 4 years. China's obviously experiencing some pain from this. It's not that the U.S. is not, but it's not to the degree that China is. And you may have noticed that China recently reduced the reserve requirements for their banks, which is a piece of evidence that suggests there's more economic impact there than what they're talking about in the headlines.
If you were to couch an agreement or non-agreement, I know obviously details are critical and they matter, but if we got an agreement, because a lot of it is just the sentiment, if you will, of CEOs, right, as to whether or not they're seeing this as an obstruction to growth, and so that affects their investment ideas. If we get an agreement, again, without the details being known, or don't get an agreement over the next year, how does that influence? Is it influencing your models in terms of what you think about for the overall economy in terms of GDP?
So the models are based on actuals. So any forecast is simply a complex averaging through past data with a projection for what the future might look like. The way it plays in the front office of a company is that until an agreement is established, there is uncertainty about the value of any investment because you don't know what the costs and returns will be from that investment. So it tends to tamp down the level of investment. In this case, because it's an international trade environment, it's particularly for companies who have exports from the United States or overseas operations to consider. Less so for domestic domiciled firms whose markets are primarily domestic, although there is a second round effect on them from a competitive position to companies that have both domestic and foreign investments. So just eliminating that uncertainty is helpful from a business planning perspective.
So that brings us to the Fed meeting. They are scheduled to meet September 17th. They have a 2-day event that they have, and I think all eyes are watching, expecting at this point almost, that there's going to be at least a 1/4 point cut. Some are, of course, the outliers are talking about a 50 basis point cut. What do you think happens in that meeting, and how do you think it affects interest rates as we think about them every day, i.e. 30-year fixed rate mortgages?
We have in our formal forecast, which is public, we have a 25 basis point cut in September and then another 25 basis cut in December. If you look a little further out, the forward curves in the financial markets suggest another 25 basis points cuts in 2020. We've not put that in yet because we're waiting to see what the impact will be of the rate cuts that are coming. Can mortgage rates come down? Well, there's three things to think about there. One is clearly the rest of the global economy is slowing. So a question is, does that lead to a flow of capital into the United States, which is the best looking horse outside the glue factory? And will that hold longer rates down? The second thing is what we were just talking about, which is the trade question. To the extent that there is a reduction in the volatility of the discussion of trade, which has shown up in capital market volatility, that's one thing that has kept mortgage spreads wider than you might have anticipated. And then in addition to that, the current low level of rates has led to some capacity constraints as mortgage lenders broadly were not expecting rates to be as low as they were and some are trying to staff up. But if you can't do all the business that's available to you today at the interest rate that you have, why would you lower rates further? Because you won't be able to do the business at that level. So interest rates become a little bit of a capacity management tool. And so those things suggest that rates coming down will lag what happens with the treasuries if the treasuries do come down.
That last point, just for audience today, there's a swell of refinances that have taken place in the industry. Now it's about 65 to 70% of all the mortgages that are being produced, and mostly the larger banks and other companies, not a Supreme. We focus predominantly on purchase money mortgages, but those companies now are inundated with refinances. And I think Doug's point is that they could theoretically have rates lower today, but for capacity purposes, they simply cannot take on more capacity at this point, or more volume at this point, because their capacity is already absorbed. So great. Thank you for that. You know, there's negative rates around the world today. We hear about that now, which is almost impossible for me to wrap my head around. You concerned about negative rates coming to the United States?
Well, we think we're actually putting some thought behind that. We think there are some pretty strong reasons why that is unlikely in the United States. In particular, ours is a capital markets, financial market, which is not specifically commercial bank centric, and most other countries have very bank centric capital markets. The broader structure of ours suggests that the market participants would not accept negative interest rates. That said, you want to be really careful about saying it's never happened before, so it can't happen, because as we saw in the financial crisis, there were some things that were believed couldn't happen that actually happened. So we're cautious about that, and we do note that Denmark, which is the only other country around the globe that has long-term fixed interest rate, level payment, self-amortizing mortgages, now is issuing 10-year mortgages with negative interest rates. Now, their structure's a little different than ours, but that is something that is notable.
So we'd actually be paying you to take out a mortgage. It's a little weird.
Yeah, think about it from financial theory. When you think about the duration in financial markets, the duration of an asset, the duration becomes longer than the expected life. And I'll guarantee you won't find a textbook in finance departments that explain that.
Yeah, I'm still, like I said, I've been in the business 35 years, have financed over $50 billion of mortgages. I'm still wrapping my head around it. So I think it's probably beyond our audience today to do that. So we've talked about a lot of things, and we haven't talked about housing. Last time when we talked, we were reflecting on the conditions of, kind of things that really drive housing. Employment, 3.7%. It continues to be at generational lows. We also have interest rates, the cost of money at generational lows. And we were reflecting the fact that the market, we were talking about struggling to maybe be up 1% this year in terms of sales, housing sales year over year. At the time you made the comment, it's all about supply. We still there today? Is it all about supply still, Doug?
It still is. And we haven't changed our forecast much. I think we dropped from 1% growth to 0.6% growth. And some people say economists put decimal points in their forecast to demonstrate their sense of humor. So that it's basically the same forecast as we talked about in July. The one thing I would note, which is evidence that it is still supply, is house prices, which had been gradually slowing, still increasing, but at a slower pace, reversed themselves just a little bit and have actually increased in pace a little bit. To me, that's completely a function of the supply issue. Longer term, we still expect to see that 2017 was the peak in both house price appreciation and the activity level in this housing cycle. That doesn't mean we're forecasting a big downturn or anything like that. We just think that the peak is past. If you look at, like I say, for 2019, which we're now pretty well through the year, given that it takes 45 or 60 days to close a home sale, a little less than 1% growth this year. Next year, pretty similar to that, maybe just a little bit more next year in 2020. So not much change in our view.
So that's good news, because when we go back to 2018, earlier you created a definition generally that when there's 2 quarters consecutive of negative growth, that qualifies as a recession. I was looking at the numbers you're forecasting, and just going back to 2018, we technically had then a housing recession in terms of unit sales in 2018. This year, while we're going to be up 0.6%, I thought I heard you say, right?
Yeah, basically flat.
Yeah, not great, but not a recession. And next year, you're feeling like we'll do on the margin just a bit better maybe than this year, at least based on the way things are stacking up right now.
Yeah, that's right.
So if you were in the audience today and you were going to pay attention to 1 or 2 or 3 drivers, there's a million data points in the economy, news that comes out daily, right? And so if you were running a real estate company or running a mortgage banking company, if you were a realtor, if you were paying attention to 1 or 2 or 3 data points, which ones would they be to tell us where the direction of housing is heading?
Well, I like simple, straightforward kind of indicators. And one thing that we know is somebody's going to buy a house, they have to have an income, and that suggests they have a job. And so I always watch the employment statistics. Even though they are a lagging indicator, you still can pick up some clues. And the most recent Labor Department report was down in terms of the new jobs added, only about 95,000 jobs in the private sector, which was lower than what we had expected. We were thinking about something in the 140 range. One thing you have to pay a little attention to over the next several months is the Census Bureau is hiring now for the decennial census, and that's going to be probably upwards of 500,000 jobs, but those are temporary jobs and will go away in the middle of next year. So the other clue in the Labor Department data is that when each month when they release the data, they revise the last 2 months' data for additional information that they've collected. And when employment is slowing, those revisions tend to be downward. And when employment is accelerating, those revisions tend to be upward. For the last 4 months, the months revisions of the last 2 months have actually been declining, have been lower. So that suggests that our forecast of going into 2020 with a slower economy is being backed up by what's happening in the employment space. So employment is number one. The second one, obviously, is there a related piece of evidence in interest rates, where interest rates are coming down because there's an expectation of slowdown in growth, and that is taking place as well. Now, if we were in an inflationary environment, that's not as good of an indicator, but we're not in that environment. Inflation is well under the Fed's target, or has been. So that suggests slowing, and that slowing in growth is global. The other thing that I watch, and we talked about this a little earlier, is business investment, because business investment is what drives gains in productivity, which is what drives real income gains at the household level. And while there have been, even with low levels of investment, there has been pretty strong growth in household incomes recently, but without that investment and that rise, with that rise in income, what you're likely to see is corporate profits start to fall, and then you'll start to see employment slow further. So those are like 3 things that you might kind of keep an eye on, 3 or 4 things that you might keep an eye on.
Good deal. And we'll then update our viewers kind of on a regular basis as to the monthly reporting on these items so that they can kind of keep in step with us. We're really interested in giving people the tools necessary so they can be their very best personally and professionally, and those pieces of advice in terms of what to follow is helpful as people think about investing in their business, adding staff to their business, et cetera. So we appreciate that. All right, so the last question I wanted to ask you, always ask you, and I love your answer to it so it doesn't get tiring for me to ask it. And I think it's really important because to the extent that these investments buyers and sellers are making are some of the biggest financial investments they'll ever make in their life. And moving isn't necessarily fun. So it's one of those it's one of those activities that comes with a lot of stuff, stress, if you will. But is it a good time to buy, Doug?
Well, the answer is always the same. If you have a family budget, which you should, then if at today's interest rates, looking at the property that you want to buy and the size of mortgage that you have to take, if it works in your family budget, then it's the right time to make the decision. If you're betting on where interest rates are going to go, then you've turned yourself into a speculator, and whether you can be a speculator or not is a discussion about how much risk you want to take on. So, if you're buying a house to live in it, which is if you're not an investor, if you're buying a house you plan to live in, that's kind of how I would approach the issue.
I love your answer for a couple of reasons. First of all, it fits perfectly with our program, Personal Professional Best. A component of it is personal finance, and that is to start out with, making sure you know where your money's going in life, right? Have a budget. So the fact that you reaffirm that all the time, I really appreciate you doing that. The second part of it is it simplifies what can be a really emotional process in terms of the idea of maybe multiple bidders on a house, or you're receiving a contract to sell the home that you're currently in, and the emotions that go into that process can sometimes be distracting for people who don't do this all the time. So keeping it simple, get a budget. If it fits and you want to live in the home, then it's a good time to buy. We really appreciate that advice that you give all the time. So basically, just wrapping up overall, if folks are in the audience today, they shouldn't worry about things they don't have any control over. Right, that drives up our cortisol. Go take a run, drive down your cortisol. If you were with us last month, we had a program on stress, anxiety, and worry. So don't worry about U.S. And China trade deals. Don't worry about inverted yield curves. Let Doug worry about those things, okay? And just report the information to us. Doug is encouraging us to track employment, what's happening with employment, and track interest rates, what's happening with interest rates related to our business and where our business is heading, and in business investment as well. And his forecast is for the year to end in a position where he is projecting it to be up from last year, just below 1%, and then next year on the margin, a little bit better than what we saw in 2019. Doug, I so appreciate you taking the time, making the time for all the folks that are a part of the Personal and Professional Best program. We wish you a great day and a great week. Thanks for being here today.
My pleasure, and thanks very much for the invitation.
All right, Doug. Talk to you soon.